I was invited to a small conference last weekend with innovators from different industries across the country, and the number one lesson that I learned had nothing to do with the conference itself, but it was the fact that regular people and very smart people have no idea of how our economy works, and they have no idea of what's happening in our economy right now. When it came to the topic of the economy, 99% of what I heard is that our economy is booming and there's no risks in our economy right now. And then when it came to the topic of interest rates, it got even more interesting because 99% of what I heard on the topic of interest rates is that by the end of 2023, interest rates are going to be lower than where they are right now. Why? Because interest rates are too high, so it's not sustainable to have interest rates high for this long, so interest rates have to start falling. This was a good reality check for me because I am submerged in the world of finance. Everything that I talk about here on YouTube has to do with finance and the economy. Everything that I talk about my employees has to do with the economy and finance, and everything that my companies do has to do with finance and money. So I just kind of started to assume more and more that more people are educated about the economy and what's happening in the world financially. But this was a good reality check to realize that even if you're well educated, even if you're very smart, even if you seem like you understand a lot of things with business, that doesn't mean that you understand what's happening in the economy. Instead, the things that I did here were people trying to figure out how they can pull the most cash possible out of their home through a cash out refi, people trying to finagle their way to buy a brand new truck that they can't afford, and people trying to figure out if they should sell their stocks at a big loss right now. The reason why this was so eye-opening for me was because it really showed me the golden era that we've been living in. We've become fat as a society, where we have well-educated, smart people making good incomes who are living way beyond their means. Why? Because we've had easy and cheap access to free debt for so long. And so as a society, we've become so accustomed to this idea of being able to live beyond our means, being able to have all the nice stuff, even though we can't necessarily afford it, to be able to consume, and get fat. And this is where we assume that the party will last forever, but it can't. And when the music stops and the lights turn on, that's when you'll see who's been partying too hard. I want to talk more about this, but as a little aside, the reason why I'm making this video like this and why the next couple weeks of my videos are probably going to be like this is because, well, I fractured my ankle over the weekend and now I got these crutches and I got this big thing on my foot. So it's going to be a little bit more difficult for me to stand up and make videos for a little while. So just a heads up to bear with me with these sitting down videos for a little while. On the economic side, what we're seeing is that the influential people in power, from the government to the Federal Reserve Bank, don't want to admit that we have any sort of economic concerns because they don't want people to panic. It makes sense in theory. Could you imagine if the government came out and said that our economy has a bunch of red flags right now and you need to start preparing? People would freak out and they would sell everything and they would make bad financial decisions. So they just avoid the topic completely because we don't really have any sort of financial education. And I should also mention that you always, doesn't matter which economy, which economic state that we're in, you always want to be preparing for a recession because recessions happen every 8 to 12 years. They have happened forever and they will continue to happen. So you want to always be preparing because when you prepare, then you can not only survive but thrive through an economic slowdown. And the reality is it costs you nothing to prepare, but if you don't prepare, it can cost you everything. So while we keep hearing that nothing's wrong in the economy, at the same time, we're seeing our economy slow down. And at the same time, the Federal Reserve Bank has to keep raising interest rates to bring inflation down. Now, this is where the counter argument is, what do you mean? Interest rates are way too high. Interest rates are going to start coming down, and we're probably going to see interest rates fall by the end of 2023. See, this is where that topic of intent is so important because if you ask most people in the mortgage industry or in the real estate industry, which are very sensitive to interest rates, they keep saying that interest rates are going to fall in 2023. We've seen article from the Mortgage Bankers Association to the National Association of Realtors talking about how interest rates are going to fall. But what is the justification as to why interest rates are going to fall? Well, interest rates are too high and people aren't getting loans and people aren't buying homes, so interest rates will have to fall. It's a very surface level argument without actually digging deeper into what could actually cause interest rates to rise or fall in 2023 and 2024. This is where now let's take a step back and really understand what's going on with the economy and interest rates. That way you can make a well-educated decision and not just rely on other people's opinions. Here's the thing, our interest rates on our debt are controlled by the Federal Reserve Bank. The Federal Reserve Bank is the central bank of the United States, and although they're called the Federal Reserve Bank, they're not federal. It even says so on their website. They're not a reserve. They don't keep any cash reserves, and they're not a bank. You and I can't go there to deposit money. Now, while they are called the Federal Reserve Bank, they do control our interest rates. And what they do is they control interest rates as kind of like a thermometer of our economy. Because when our economy is overheating, it's growing too fast, then what they do is they try to cool the economy by raising interest rates. Because when our economy is growing too fast, typically what that means is that inflation is running hot, the price of things are rising, and there's too many dollars in our economy. This is what causes that heating, the overheating. We saw this over the last couple of years. Well, when you see that overheating, the Fed comes in to cool down the economy. The way that they do that is by raising interest rates. Now, when you raise interest rates, you make borrowing money more expensive. When you make borrowing money more expensive, less money enters our economic system. Because when you go and borrow money to buy a home from the bank doesn't have the $350,000 just sitting there. Some of that money gets printed through the way our banking system works. Fractional reserve lending, the way that it works is banks don't keep all this cash. They can print money essentially out of thin air. So the more money that people borrow, whether it's to buy a home, whether it's for credit cards, whether it's a business loan, the more money that is borrowed, the more money that's created. The more money that's created, the more money that enters the economic system. The more money that enters the economic system, the higher the inflation that we see. The higher the inflation that we see, the higher prices go. So when you have this growth, the super hot growth, the Fed will want to cool it down. That way inflation doesn't get out of control. The way they do that is by raising interest rates. Likewise, in the past, when you have a cooling economy, well, that means not enough money is going into the economy. The economy is slowing. Businesses are shutting down. You have people that aren't able to pay their mortgages. You have a bunch of things happening that are cooling the economy. So to now grow and stimulate, that's where the Fed can turn up the thermostat and they can now cut interest rates, which makes borrowing money cheaper. If tomorrow the Federal Reserve Bank said we're going to slash interest rates back down to zero and you could get a 30-year fixed rate mortgage for 2.5%, what would happen? You're going to see a flood of home buyers enter the market again, which means you're going to see more and more people borrowing money, more dollars entering our economy, which means more people buying homes, which would then push home prices even higher inflation. So this is where when you're in that cooling phase, the Fed then starts to cut interest rates as a way to stimulate. Now we cover what's happening when it's happening in my daily free newsletter called Market Briefs. If you haven't joined Market Briefs yet, I recommend you do so because it's a super easy way and a free way for you to stay up to date on what's happening in things like the housing market, our economy, the stock market, crypto, and our global economy. It's a fun, witty, and easy to read email. You can read it in less than 5 minutes every morning. So if you haven't joined Market Briefs yet, I'll put the link to how you can join down in the description below. But this is where now you have to understand first, the Federal Reserve Bank controls interest rates. When they raise interest rates, this puts upward pressure on mortgage rates. When they cut interest rates, this puts downward pressure on mortgage rates. Right now, we are still facing extremely high inflation. Inflation has fallen off of its peak, but we're still closer to our peak inflation than we are to our target inflation. What is target inflation? According to the Federal Reserve Bank, this target inflation is 2%. 2% is how much inflation the Federal Reserve Bank wants to see. Why is it not 0%? Because, well, the Federal Reserve Bank always wants to see some inflation. They don't want too high of inflation, but they want some inflation because that means that there's more dollars entering our economy, which allows our economy to grow even quicker because there's more and more dollars that keep entering our economic system. Now, they want it to be around 2% because that's a low enough number where the average person doesn't notice inflation. Now, this is where I want you as a smart investor to understand that inflation disproportionately hurts the financially uneducated and it disproportionately hurts the financially poor. At the same time, inflation disproportionately benefits the financially educated and the wealthy because, well, the reality is inflation is a hidden tax. Most people never see it happen and you just continue to seeing your savings power be eroded. You continue to see your salary lose value. That's what inflation does. It causes the value of the dollar to go down, causing the price of things to go up. So you feel much richer when you get a raise, when in reality, that raise, if it doesn't keep up with inflation, you're slowly becoming poorer each and every day. This is why that financial education is so important. So the Federal Reserve Bank controls interest rates, which impacts inflation. And right now we're in a stage where inflation is still extremely high. And at the same time, we're seeing our economy slow down. Our economy is slowing down because, well, of the high inflation. People can't spend it the way that they could before. Our economy runs on spending. When you go and spend money at Chipotle, Chipotle makes money. If you can't afford Chipotle anymore because Chipotle keeps raising the price of their extra guac, well, now less people are buying the extra guac and less people are going to Chipotle. If less people are going to Chipotle, that means Chipotle is making less money. If Chipotle makes less money, they have less money to hire more employees. They have less money to open more stores. They have less money to invest in a better guac recipe. If they're investing less, that means people are making less salaries. People have less jobs. They're not investing in more real estate. That means less construction jobs. So our economy runs on spending, but spending is slowing because of high inflation. But at the same time, in order to bring inflation down, the Fed has to raise interest rates. They're cooling down the economic thermostat. So they're raising interest rates, which puts upward pressure on mortgage rates, on car financing rates, on bank financing rates. And what happens when things become more expensive because rates are higher? Well, then you have less people that want to buy things. And this puts downward pressure on asset prices, on things, because now if mortgage rates were to double tomorrow, it's easier to understand. If mortgage rates went to 12% tomorrow, what would happen? Less people are going to buy homes because it's going to be much less affordable. In order to justify a higher mortgage rate, you need a lower price of the home. And so this is where you can see downward pressure on homes and stocks and business prices and kind of valuations of everything because the cost of borrowing money is more expensive. Now, this is where people assume things that are going to happen very quickly. They assume, oh, if mortgage rates are higher, home prices have to fall quickly. Well, not necessarily, because you have sellers who have to voluntarily sell their home at a discounted price. You have a lot of sellers saying, oh yeah, we're just going to wait until interest rates go back down, so we don't want to sell our home yet. And so they wait. And this will continue unless you have voluntary sales go away and more involuntary sales come in. Involuntary sales meaning people are forced to sell their home because, well, the bank comes in and they take your home from you because you haven't been making your home payment. Or your car gets repossessed because you haven't been making your car payment. We have been seeing repossessions rise. And so this is where now looking at debt levels is important, because now when you have high amounts of debt and people and businesses lose the ability to pay the debt, that's where you can see more pain, because then you can see more involuntary sales. But understanding, okay, we do have many red flags in our economy right now. Understanding this, and that is why you should be preparing, not going out and trying to borrow as much money as possible to buy a new truck. Not going out and borrowing as much money as possible from your home, that way you can buy a car, that way you can buy a vacation, that way you can buy a boat. Being smart with your money today. This is why it's important. Because the reality is when you assume that this party lifestyle can last forever without thinking anything bad could ever happen, that's when something bad happens. And that's what you want to be prepared for. I'm not saying don't enjoy money. Enjoy your money, but just be smart and understand what's happening. That way you have some cash put aside. That way you are protecting yourself. That way not only can you survive through an economic slowdown, but you'll be able to thrive through any sort of economic slowdown. Last year, my accountant kept telling me to buy a G-Wagon. Why a G-Wagon? Because he said that we could justify that if I bought a G-Wagon, he could say to the IRS, look, Jaspreet is an influencer. He needs to maintain his image as an influencer. How can he do that? Well, he can buy a G-Wagon, and now this G-Wagon is a tax deduction for him. Now, did I buy